momentum is real, right? So things tend to stay in motion until something actually stops it. Right? Just go back to physics 101. Yeah. So the market can continue to go higher until it hits a headwind that literally snaps the other way. So just because it's overvalued doesn't mean it won't stop going up.
Now, big picture, David, you sent this around to the team. Earning estimates for S&P are now back to the same level they were when the index was trading at 5,100 or $273. Historical multiples are 17.4 times the earnings. You're worried that there's a disparity between what we see in the actual fair value of the S&P index. Am I right?
Oh, absolutely. There's no way to sugarcoat the market's overvalued. Doesn't mean it can't keep going. The markets will get overvalued from time to time. But the chart we're looking at, for those of you that are not watching on YouTube or just listening, is basically we have a chart of the S&P 500 basically, and going back over the last year or so, and then we have a chart of earnings expectations we can put right beside it. So earnings expectation is forward-looking 12 months at a time, right? So earnings expectations for this year are significantly lower than what you see on this chart, the 273 number that's referenced. That is 12 months out. All 500 companies, the S&P, combined all their earnings, and if you had them as one company, they would earn $273 a share, basically. So that's how this math works. So historically, we're willing to pay a certain multiple, right? How many times earnings are you willing to pay to buy the market? Well, historically, as you mentioned, it's 17.4. Well, that would be a price, means fair value 12 months from now would be 4,700 points on the S&P. We are currently just hit all-time highs over 5,800 and change. So that would be a pretty severe correction. Now, again, these corrections happen. We always revert to the mean. I don't know when it's going to happen, but it will happen. And what we want, the point here, Chip, is we want people to understand is, listen, if you're 35 years old, you can weather the downstroke, and hang on long term and just keep dollar cost averaging buying. But if you're within 10 years of retirement, can you afford to have a 20 or 30% retracement of your assets?
And you don't have that margin for error anymore.
So we want to show people how to diversify their portfolios away from equities. We have all-time high in equity allocations for the average household in America right now. And again, goes all the way back to the dot-com era where people are super bullish and just, nothing can stop this. And, there's something from left field usually comes in and does, in fact, stop. So we want to show you how to diversify your portfolio and not hurt your long-term average rate of return over a seriously long period of time, 10 and 20 years, because you're going to be retired for 10, 20, or 30 years. So we want to show people how to diversify. Ray Dalio, one of the greatest managers of money in history, talks about you need to have diversification amongst 8 different strategies or so, and you reduce your risk, according to his research, by as much as 80%, and you get to the same place. So, but the problem is the average American, Chip, only knows stocks and bonds. That's really all they know. So we want to show people how to diversify much farther. So most of our clients own some form of real estate in some capacity. They own some form of commodities. They own, bonds. They own stocks, equities, et cetera, and a myriad of other things. They have principally protected accounts. They can put money in CDs or even high-paying money markets right now. So are things you can do to diversify your risk, but you have to work with somebody who shows you how to have non-correlated returns across multiple strategies simultaneously.
What hits me when I see a disparity like this is I'm not a professional number cruncher, but David, there's something emotional. There's some kind of, sometimes it's euphoria, sometimes it's hysteria that invades and infects the marketplace. And it just, despite what the data is, we still see things like this. How does this happen?
Well, so, momentum is real, right? So things tend to stay in motion until something actually stops it, right? Just go back to physics 101. Yeah. So the market can continue to go higher until it hits a headwind that literally snaps the other way. So just because it's overvalued doesn't mean it won't stop going up. So you have to understand it's a machine today. 401k investing every week through payroll deduction, 403b, TSP, all these. So this machine keeps putting money in the market until there's some kind of event where people actually get nervous and stop contributing or contribute significantly less, et cetera. And there's a geopolitical event or a seismic event, whatever, in the markets. And then it turns and everybody pulls at once. And that's why the market goes down at 4 times the rate of speed at which it goes up. So we always say, look, you take basically the escalator up, but the elevator down. So you just want to be prepared for when that elevator does drop out here.